Good morning and welcome to the Eastman Financial Report. I'm Dan Eastman, your host, and today is Monday, February 9th, 2026. Thank you so much for tuning in. As always, we appreciate your viewership here at the Eastman Financial Report, broadcasting from the mighty Cobalt microphone in the great metropolis of the city of Milwaukee, Wisconsin. And we're on the air live from 11:30 to 12 Central Time. And we do appreciate your viewership, taking time out of your busy schedule to watch this program free of charge, no paywall, no subscription. This is a broadcast ministry that is freely given. And it is a ministry, as you know, we're part of Worldview Foundation, worldviewtube.com. And we have been broadcasting in this Christian space since 2006. This is a Christian broadcasting network. And it's our ministry, our mission, our goal, and our passion to be able to bring to that great marketplace of ideas the news and information of the day from a Christian perspective. And that's really important, and that's what we do. And that's what we've been doing since 2006. So if you'd like to help us in this ministry, in this effort, you can do that by going to worldviewfoundation.com and making a donation. You can sign up for a one-time donation, or you can sign up for monthly donations, and that has the added economic benefit of flattening our revenue curve so we can better match cost to revenue, keeping the bottom line in the black, and of course, continuing to broadcast our message free of charge, just the way the apostles did 2,000 years ago throughout the Middle East. They weren't charging an admission fee. That wasn't entertainment. That was a gift, an amazing gift, freely given. And we continue that tradition today because until the second coming, we will be broadcasting from a Christian perspective. And that's why it's important that we continue to do this. And that's why if you can help us do this, it is appreciated. Again, that's worldviewfoundation.com. If you go to the website, you can sign up and make a donation. You can also help us in this ministry by doing business with the companies you see advertising throughout the day on the network. Unlike the big boys, we don't sell blocks of commercial advertising time. That's not our business model. Our business model is to find companies that we know and trust, and then we do business with them, and we offer their goods and services to our viewers. And when you do business with them, a small portion of the proceeds comes back to us in the form of a commission, and that also helps us remain sustainable. We don't want to have a paywall or a subscription fee for our content. It's freely given. And this, again, helps us when you do business with those vendors. There's a third way you can help this ministry and at the same time help yourself and perhaps others as well. We've come up with a product called worldviewtube.com/vault. And there's a little paywall here, but that's the point. It's subscription. And here's the address on the bottom of the screen, worldviewtube.com/vault. If you subscribe to the Vault, you are getting some amazing Christian content that Brandon Howes, through his life of his ministry, has put together. He's been doing this since 2006. He's written 15 books, and many of those are now digitized. And his events, his conferences, his seminars, all of that data is now collected in the Vault. So when you subscribe to the Vault, you have access, on-demand access to amazing Christian content that is quite spiritually uplifting. So if you're like me, and sometimes you hit some rough spots in life, and you're thinking, gee, I would really like to have a tool in my tool bag that I could go to from time to time to give me a little boost. We always have scripture. You always can hear the word of God speaking to you through scripture, but sometimes you want to be in part of a fellowship of Christian believers, and that's the beauty of the Vault. When you go into that particular product, the Vault, subscribe, you have some amazing content, and that is quite uplifting. It can be very spiritually uplifting and fulfilling. So if you hit rough spots, that's a nice little tool to have in the tool bag. But more importantly, we all know people who are struggling in life, and this is a wonderful gift to give them as well. Give them a gift subscription to the Vault, because that is, what do you do when somebody's struggling in their spiritual life, or their life, their basically financial life, personal relationships, all the pressures of the day? A subscription to the Vault could be a very, very helpful, useful, and wise gift to give a friend or family that's struggling. So anyway, that's how you can help our ministry. You can make a donation, which is always appreciated. It's wonderful. And you can make a donation anytime, day or night. Just go to worldviewfoundation.com and do that. Do business with the companies you see advertising, because the products and services they offer are good stuff. And you're helping not only yourself and the vendor, but you're also helping the networks. Win, win, win. And of course, course, subscribe to the Vault, which is really a wonderful treasure to have. Okay, let's jump into the news. And there's some interesting debate going back and forth. There was news over the weekend into this morning concerning the People's Republic of China. And of course, we know that that's a big place with 1.5 billion people. And I think if anyone in America is keeping an eye in the rearview mirror, it's watching China because it's an important place. But the story was that the Chinese government, and of course, we have to understand that the Chinese government is not like the American circus we have in Washington, D.C. It's a monolithic thing. A lot of people, freedom lovers like myself, are very nervous about the communist government controlling the whole 1.5 billion people. But the point is, it's an efficient machine that does national policy. When it moves, it's very, very effective, and it is very efficient in how it operates. And it's sort of it's one of those governments. I've been to China a number of times. It's quite impressive to see if they want a road or a highway, it happens. They don't sit and debate about it. They just make it happen. The point is, the Chinese government told its banks within its banking system to lighten up on U.S. Treasury debt. And of course, that set off bells and whistles throughout the financial world, at least the financial media world, because there's always the concern of a foreign actor using America's debt as a weapon against the United States. And because we've created the $38.5 trillion in national debt, and then, of course, we have a $2.5 trillion annual deficit that makes the debt get bigger, and because we're spending $1.2 trillion on interest on the $38.5 trillion debt, which is over 25% of our federal revenues, tax and tariff revenues, we have created within our system a vulnerability to United States national security. And it's been created by our Congress, who simply cannot pass a balanced budget or live within its tax revenue means. So we have accumulated this $38.5 trillion in debt. It's out there. These bonds, these notes, these bills are floating about the world. And about $9.4 trillion of that $38.5 trillion is held by foreigners. So that kind of gets to be a third-ish of all the federal debt outstanding. Now, if you understand the federal debt market, and very few people do, I'm sure I don't myself, but let's pretend from a theoretical or an academic perspective that we understand the federal debt market, there's a body of debt floating about the universe, or at least the world. Wouldn't it be grand if we could get people on Mars to buy our debt? Don't give these people in Congress any ideas. But the point is, there's $38.5 trillion in debt floating about the globe, okay? And it's owned by not only the Chinese and the Japanese. Japanese are our largest holder of foreign debt, at a little over $1 trillion. They're starting to dial back. China's a bit less at about $800 billion, almost $1 trillion. And of course, throughout the world, about $9.4 trillion of American debt is held by foreign people, foreign governments, foreign banks, foreign investors, foreign mutual funds, foreign holders of debt. Well, the thing is that the U.S. debt market at $38.5 trillion is a system. It's an ecosystem. It is a system. And if you were Adam Smith living in the 1700s, first you couldn't imagine. First of all, you couldn't imagine a United States. Secondly, if you could, you couldn't imagine a United States crazy enough to compile 38.5 trillion in debt. But the point is, if you were Adam Smith, you would be looking at this $38.5 trillion as a universe or a system, a closed system. There's only so much debt in existence, and every last bond, bill, and note is an asset on somebody's balance sheet, including the Fed's balance sheet. But it is a universe. And within that universe, that $38.5 trillion is the supply. If you think of Adam Smith's supply and demand, the great supply and demand curves, well, that is the supply. Now, of course, the federal treasury, because it's doing what Congress tells it to do, spend more money than you have, so you have to go out and borrow another $2 trillion. You're adding to that universe, but it is a defined universe. So anyone playing in that market on the demand side, if you wake up one day and think, I'd like to own a federal bond, that would make my day. Boy, it'd be just so cool. I could buy that federal bond and put it on my mantle and people would come over and admire it. Okay, so you have this moment and you want to buy a bond. you are part of the demand for the bonds. And the supply is this universe. It's what's outstanding plus whatever the federal treasury is buying back to refinance and issuing new debt, always at a higher always had a higher interest rate. And effectively, that's the supply and demand market. So if the supply in that market is fixed and the demand is somewhat variable, because in order to go into the federal debt market and buy debt, you have to have some money, okay? And you think, gee, I'd like to buy some debt. I'm running a pension fund, or I'm running a mutual fund, or I'm running a bank, or perhaps I just want to stuff one under the couch cushion or on the mantle. You need some cash to do that. So you go into the debt market, and there's two kinds of debt that are happening. It's the 38.5 trillion in existing debt that is effectively being bought and sold or held all day long. It's a very dynamic market. And then there is the new issue, which is theoretically smaller, because if you think about a $2 trillion deficit with a $38.5 trillion universe, that $2 trillion doesn't really change the supply curve that much. It expands the supply curve, but it doesn't change it. So the point is, when you're in an equilibrium market, and that federal debt market is always in equilibrium because of the demand for federal debt globally and the supply of debt, which is relatively fixed. There's the outstanding debt and the new debt, and that is that universe. So when you look at that at any point of duration of the bond, the 10-year bond, the 30-year bond, the 1 week bill, whichever denomination or term unit you're looking at, there is a supply and demand, a quantity demand that at a price, and that price is the interest rate for that debt. So if you look at the 10-year bonds, there's a whole bunch of them floating around the globe. It's hovering around 4.2%. Annualized interest. Now, that doesn't mean that they're issued at 4.2%. They're issued at a nominal face interest rate, and then the market adjusts it accordingly. So that bond value, the $1,000 in incremental bond value, will either go up if the interest rates go down, or go down if the interest rates go up. And this is the market that you're playing in if you're buying federal debt. Well, the reason that market doesn't go bananas and all of a sudden interest rates go to the moon as the federal treasury issues more and more and more and more debt. And why do they do it? Are they nefarious? No, they're following the law. Congress passes all of these enabling spending bills. The president signs them into law. Treasury has to fund it, and they borrow more money. How do they do it? They sell bonds. They sell bonds. So there's this dynamic floating around in that market. And because the Federal Reserve has monetary policy authority from the Congress, the Federal Reserve, and that's what we go into the Federal Open Market Committee, dance every couple of weeks. They go into a secret conference for 2 days, have a nice lunch, come out on the balcony, and they decide whether the rates are going up or down or staying the same. All of that is part of the Federal Reserve's monetary policy, and their job is to keep the interest rates within their prescribed band. So they want like a 10-year bond. Right now it's at 4.2%. They don't want it going to 6%, and they probably don't want it going to 3%, although the rest of the world would sing out loudly and rejoice, rejoiceful refrain. But the point is, that's their job, is to keep these interest rates within a bandwidth that they feel is good for the economy. Now, it's a power they have given by Congress when they created the Feds. It's their monetary policy. That's how it works. But the point is, that's their job. And in order to do that, the Federal Reserve has to affect those markets. Now, we watch they come out on the balcony and say, well, we're going to keep the interbank lending rate, constant last time around, which means the money, the rate that banks charge each other for overnight loans, which is, I've always said, it's a trickle out. It's not trickle up or down. It's trickle out. It's slow motion. It's 8 to 10 months, it's irrelevant. It's irrelevant. But how the Fed really plays the game is at the open market trading desk at the Federal Reserve Bank in Manhattan, where they are buying and selling bonds throughout the day to keep those bonds at a price where the interest rate stays within the bandwidth. That's the federal open market activities. And it's a very important thing because it has an immediate effect on interest rates. So what the public doesn't think about or see is the Federal Reserve, through its primary operators, will go into those markets and they will buy and sell and buy and sell and buy and sell bonds to keep those interest rates in line. Okay. And that's why the Federal Reserve, if you look at their balance sheet, it's between 6 and 8. It was almost 9 at one time, and in 2008, that's the $1 trillion in bonds because they have to keep sopping up these excess bonds and keep them on their balance sheet so that they're not floating around in that universe in the market. They've effectively removed that supply to restrict the supply so that when supply equals demand, the quantity demanded at that price interest rate is within the bandwidth. This is how this thing works. So when these foreign banks start to lighten up on their U.S. Debt holdings. And of course, keep in mind, this is not the federal government of China, which owns a bunch of debt, U.S. debt. That's the $800 billion. But these are the banks operating within China. But keep in mind, nothing happens independently of the party in China. It is a complete top to bottom unit. So when the federal or I should say the Chinese party dictates to the banks that you will lighten up on on your federal debt, it's no different than if the federal or the Chinese government sold the debt themselves. But they don't want to do it because that's a hostile act. If they start dumping the bonds into the market, there's an oversupply of bonds available, which means the price of bonds will fall. Supply goes up, the price goes down because there's too many bonds, and the Federal Reserve will have to step in and sop up that difference and add to its balance sheet in order to keep the interest rates in line. So effectively, with China and Japan and $9.4 trillion in foreign held debt, if somebody wanted to be, let's say, impolite to the United States, or they wanted to perform a hostile act against the United States, one way that they could do that is to start selling bonds into the global market, which will force the Federal Reserve to purchase more and more and more bonds to keep the supply and demand equal where they need it at the right interest rate. And the Federal Reserve's balance sheet just keeps getting bigger and bigger and bigger. And of course, they can do it. I mean, if you listen to the president of the Federal Reserve up in the Twin Cities, very brilliant gentleman, commented once that they have the ability to print infinite amounts of money, and they do. The Federal Reserve has the ability to sop up all $38.5 trillion in debt if they had to. Now, obviously, there'll be some pension funds and mutual funds that would still like to have some federal debt. But the point is, if it were a hostile act, it really puts us in a national security problem it's a problem of our own making. And my point is, but for the Congress spending vastly more money than our tax base and our revenue base can support and continuing to grow this massive deficit over and over and over, it's creating a national security problem where if foreign nefarious actors wanted to cause some real headaches in Washington, D.C., especially at the Federal Reserve, all they've got to do is start pushing the sale button, go to cash, go to gold or whatever, and suddenly the Federal Reserve has to leap into action and start sopping up this excess supply, which will create a very large balance sheet. And keep in mind, as the Federal Reserve is doing that, they're printing new money and putting it into the system because the people selling the bonds want cash. Then you take the cash and you buy something else, land, gold, whatever the government's buying. But it's a national security issue. And it wouldn't exist at all if Congress wasn't continuing to fuel this monster debt. They created this universe of federal debt that if that universe didn't exist, or it was very little, it was very small, like it was 30, 40 years ago, then it wouldn't be a national security threat. But today, in addition to worrying about all of the other types of hostile acts against the United States, you can put some real pressure on the American financial system just by pushing the sell button, if you are offshore somewhere, and even theoretically domestically, which would be really something. Anyway, I need to take a break. I'll be right back, and I'll talk about some other stuff. Be right back. Thanks.
Hello, I'm Brandon House. I want to thank you for all your support at WVWFoundation.com that helps make possible pushing out 24/7 content for free. Without your support, we'd have to put it all behind a paywall. But thanks to you and your support through our foundation, we're able to push it out for free as a broadcast service and broadcast ministry of WVW Foundation. Please consider going there and setting up an automatic monthly contribution, or go there and make an occasional contribution. If you prefer to support us through the mail, you'll find our mailing address there at WVWFoundation.com. You can also call and make your contribution over the phone by calling 901 825-0652. That's 901-825-0652. Again, all these details are available at wvwfoundation.com. Thank you for your support as we try to help people around the world understand the times through the lens of a Christian worldview.
Okay, so to finish that thought, where I'm going with this lecture today is that as the federal government continues to operate with a massive annual spending deficit and continues to grow our national debt, it's creating a larger and larger problem and national security issue for the United States. Because if foreign actors or others, nefarious actors, were to push the sell button and sell bonds into the market, you would immediately trigger reaction by the Federal Reserve to buy those bonds, to pump more money into the system, and that is highly inflationary. And that's why these episodes are very much worth watching. And keep in mind, when in the panic of 2007 and 2008, that was the transitional year between President George W. Bush and President Obama, the banking system hit the skids in a major way because so many of the banks had been holding collateralized mortgage obligations, and those were effectively people's mortgages that were lumped together and they were sold as securities. When you do that, when you lump millions of mortgages together into one entity, and then you sell shares in that entity, you have basically diversified the risk of default. Because if one mortgage defaults and you hold the mortgage in your vault, you've got a real problem as a bank. You've got a non-performing loan. But if you own shares of a collateralized mortgage obligation instrument and one or two mortgages default, they get blended into the ocean and nobody ever notices that. And that is the value of being able to syndicate home mortgages and commercial mortgages as well. Well, the banks holding those, what seemed logical and safe to them, holding those instruments, realized is that when somebody figured out that there was an imperfect model for calculating default rates in the underlying mortgages, then suddenly nobody knew what the default rate was, so you couldn't price that risk component into the price of these bonds, and therefore you couldn't price those bonds. And if you can't price a bond, the mark-to-market rules say that bond is marked to zero. So you have a $1,000 mortgage collateralized loan obligation bond that for technical purposes must be marked to zero because you can't calculate the default rate, so you can't price the bond. And when that happened, of course, the banks were sitting on millions and billions of these instruments. And of course, their reserves dropped perilously low, putting the whole banking structure into effectively technical default in 2007 and 2008. Well, the remedy was, and nobody really had thought about this, was that the Federal Reserve stepped in, printed up new fresh money, gave it to the banks, and bought those collateralized mortgage obligations and put them on their balance sheet until such time as if somebody could figure out what they were worth based upon a new model of default prediction. And that was the beginning of quantitative easing. And then it didn't take very long for once that cultural hill was climbed, that the Federal Reserve was actually interfering in the markets. And why is that a problem? It's because they print brand new money and pump it into markets and they pull supply out of the market. Those are market manipulations that the private sector would be a regulatory disaster for them. But the point is the Fed does this. So since 2007 and 8, the Fed has had the ability to step into markets to stabilize. And that's what they're doing with quantitative easing with respect to buying these federal bonds, pulling them out of that universe so that they can keep the supply and demand point where they need it at the right interest rate, and that's how they regulate the interest rates. So I'm simplifying it, but that's basically how it works. So when you think about how the federal government is trying to expand all things to all people by ever increasing federal spending for hither and yon, even funding some of the most amazing fraud programs ever devised by mankind into the hundreds and hundreds of millions of dollars, if not billions of dollars. I guess in Minnesota alone, they're looking at over $12 billion in fraud. Well, if you want to fund fraud at the national level, that's part of your congressional passion. You go to Congress, I want to fund fund fraud. Let's give $9 billion in fraud to Minnesota. Okay. And they vote for it and they go borrow the money to do it. Well, if that's what you do in Congress, I mean, that's what congressional representatives, that's how they think. Obviously, it's, it's the res ipsa loquitur. The thing speaks for itself, the $38.5 trillion. 2 point something trillion dollar annual deficit. So if that's your national policy to fund fraud all over the country for your buddies, then you have to think about the national security implications of having all this massive debt floating around that other places, other countries, other people can manipulate for the damage and the detriment of the American financial system. And that's really the whole crux of this argument today. Now, some commentators are saying, well, it's only $682 billion that these Chinese banks hold. It doesn't matter. The Chinese banks aren't like the American banks. They're not independent. Nothing's independent in China. It's one monolithic system. And if the Chinese government doesn't want to push the button and start World War III, they have their banks push the button and they don't start World War III, but you get the same effect. Trust me, today at the Federal Reserve, people are at the trading desk. They're going, "Oh man, we got to start." They're trying to keep the interest rates within the bumpers, and they're buying bonds. They're just doing it because it's math. It's simple math. When you break away all of the illusion and you get down to the simple math, it's really how this mechanism works. And if we didn't have this exposure, we wouldn't have this trouble. And that's why we really need to be thinking about a political discussion about how do we replace the current status quo in Washington with a logical status quo that is based upon revenues and expenditures. And you may dream the big dreams of spending, billions of dollars to fund the fraud of your choice, but maybe we can't afford that. Maybe we can't afford $9 trillion or billion dollars in fraud. We have to cut back a little bit. So it's an interesting problem. We'll watch and see what happens. But it does put pressure on interest rates. And the reason I talk about the 10-year, this is relevant to just average Americans, because the 10-year bond is what sets the interest rate in the mortgage industry. I said, wait a minute, the 10-year is at 4.2%. My mortgage is 6.2%. Yes, and that's the default component that I was talking about in 2007 and 8. The risk of default is priced into mortgages. That's why you lend somebody money for 30 years, to buy a house. A lot can happen in 30 years, and you have to factor in the risk of default, and that's one of the big components. So you take the base at 4.2% at the 10-year, and you add your default risk and other return on capital risk. And that's how you build your rate to 6.2, 6.3%. So if the underlying rate goes up, the 4.2 goes up, well, mortgages are going up. Now, not instantly, but eventually the pressure on mortgages goes up. And that's why when you look at all of the things that the Washington has done to try and bring some relief to a stalled housing market, when you look at the 10-year bond, it's still, a year ago it was 4.1, 4.2. Today, 4.1, 4.2. Nothing has changed. And it's the Federal Reserve that's doing that. If the Federal Reserve wanted to step in, lower the interest rates in the 10-year, they could do that by just buying up more and more bonds, pumping more and more money into the economy, and the price of the bonds would go up because they'd be scarce, and of course the interest rates would come down and everyone would rejoice. But then you'd have a yield curve that this is how a yield curve normally looks. These are the shortest term debt, these little T-bills and little notes. But when you get out to the 30-year, that should have the highest interest rate because there's more risk over 30 years than there is in 3 weeks or 1 month or whatever. Well, you have to have this linear curve. This is the yield curve. But if you have this dip in the middle at the 10-year, then you get this really weird-looking 10-year, and the markets don't believe that. And then ultimately what happens is you have to change the whole slope of the curve if you're the Federal Reserve. You can't just have wiggly things, a wiggly curve, because it doesn't make logical sense, and somebody who's a bond investor will invest around that dip. So the point is they're stuck. So if you want to see the yield curve start to flatten, we talk sometimes about an inverted yield curve, which it gets a little wonky, and it's always a signal of a recession. What we're really looking at is the Federal Reserve trying to flatten the curve, lower the interest rates. At the same time, somebody overseas is pushing the sell button, and they're having to do reactive buying in addition to policy buying. And that creates a real economic problem. So that's what's going on today, and that's story. It's worth watching. We'll see. Hopefully not everyone decides to push the sell button. It could be a bad day in Washington, but we'll watch that story. So we'll see what happens. Anyway, thanks for your time today. Lots of economic news coming out this week, and we'll be talking about it. So have a great afternoon. Go to worldviewfoundation.com and make a donation. And I'll talk to you tomorrow. Have a great afternoon. Bye.
We have a big announcement, folks, something we've been waiting on for